The national housing market continues to rise, and house prices once again have risen over the month of August. In fact, that's 7 consecutive months now. If you've been a regular subscriber to our weekly Property Insider video chats or a subscriber to my podcast, you'd know that earlier this year, Dr. Andrew Wilson forecasted our housing markets would change direction and house prices would rise. And that was when many were forecasting property Armageddon. Well, we're heading into the spring selling season, and today Dr. Andrew Wilson is going to share his latest housing market report. If you want to keep up to date with what's happening in our housing markets, please subscribe to this YouTube channel and click the little bell icon so we can keep you updated each time a new show comes out. We're heading into the spring selling season, and it's unlikely that at the beginning of the year, many would have believed how resilient our housing markets are. Property prices have kept rising despite 12 interest rate rises, high inflation, a reduced borrowing capacity, and the media keen to warn us that our housing markets would crash. Remember, they tried to scare us about mortgage stress, about fixed rate mortgage cliff, and even a recession. Yet property values in our combined capitals have kept rising for 7 months now. And the fact that it's unlikely that we're going to have further interest rate rises are only going to increase buyer confidence. The big four banks have all cast their predictions for the next few years of cash rates, and they're suggesting that, well, 3 of them are suggesting there's not going to be any more rises. Cash rates have peaked, and they all believe rates are going to start falling next year. Now, of course, it's possible unforeseen circumstances such as changes in global economic conditions or domestic policies could impact interest rate decisions. They're always difficult to predict, but I'm keen to hear the latest My Housing Market statistics for the end of August from their chief economist, Dr. Andrew Wilson. Hi, Andrew.
Well, another positive result for our housing markets, Michael. Over the August quarter, we have the August quarter up by 0.7% compared to the July quarter result, so which was slightly down from July. July recorded a 0.8% increase over that quarter compared to the previous month's quarter. So slightly lower, but nonetheless a positive result going forward. And I think when we put these results in the context of the winter market, which is typically the slowest period of the year, of course, with the exception of January, I think it just reflects what is a buoyant period in our housing markets, as you've described. And I think the real, issue here is that we've created a very solid platform for the spring selling season, which of course is our strongest selling season, where we do have a full mix of properties coming into the market. The winter period typically is characterised by a much lower proportion of higher priced properties. Of course, there are the holiday distractions, etc., which keep that end of the market subdued, but we will see higher priced properties coming into the market. It is the strongest period for that end of the market, the spring selling season, and that, of course, will put upward pressure on prices. And I think that we've still got some upward potential in that mid to higher price bracket in Melbourne and Sydney particularly. It has been lower to middle price properties that have led the charge this year, with the value buyers becoming activated. I think that we've still got some potential upside for the top end markets.
Yeah, in the chart that we're showing at the moment, over the month of August, because My Housing Market measures prices slightly differently to get a more balanced approach. Yeah. You've got quarterly median prices, but in the month of August, they went up 0.7% over the month of the quarterly figures for July. So it actually over the year, prices have gone up significantly, with some states, as we can see in this chart, Sydney already doing close to 8% growth over the year, and nationally 5.6%. So that's a good figure for the month, rather than some people may be thinking when you mentioned quarterly that it's over a 3-month period.
Well, the prices are measured over 3 months, Michael. That gives us a robust data set. Of course, we're measuring 3 months worth of sales, but it's compared to the 3 months of the previous month. So it's a rolling quarter measure. It reflects exactly what we get with some of those monthly results, but it provides a much more robust observation because of the number of sales involved. But yes, Sydney up 7.9% this year so far. Certainly the Sydney market is on track to exceed a 10% result over the year. Other capital cities, Brisbane up 5.8% so far this year, Perth up 6.5%, Adelaide up 5.6%. And of the major capitals, Melbourne, the underperformer, but still up 3.8% over this year so far. That's prices since the end of last year. And the full year data is also encouraging. Sydney up 4.3%, Adelaide up 7%, Perth up 7.4% over the past year. And all the major capitals are reporting higher house prices over the August quarter compared to the August quarter last year. And I think that when we put together the monthly this year so far and the full year results, it's quite clear that we've had a significant revival in our housing markets. And as you said, this was clearly not predicted even some months ago. But we now have, I think the big picture is a very solid platform for more price increases over the spring selling season, which is traditionally the strongest period of the year. And of course, as you mentioned, the likelihood is that we'll continue to see perhaps pauses in interest rates, a flat interest rate policy going forward. Not so sure we've absolutely reached the peak of the cycle. We need to still get a bit of more of a handle on inflation. But the data coming out certainly supports what the Reserve Bank has been doing with 3 pauses over the last 4 months in official rates.
The outlier this time round seems to be Hobart, which was the darling of the property investors a number of years ago, but it's gone the other way.
Yeah, I think that's interesting, isn't it, Michael? Because Hobart tends to be a contrarian market to some degree. It rises when others are falling, and now it's falling when others are rising. But it did have a very strong period a couple of years ago, as you mentioned. Perhaps there's some adjustment going on, but it has been a softening market. But just recently, we've seen perhaps when we look at the daily quarterly figures, how's that for an insight? We can see that perhaps there's some steadying in the Hobart result, but it certainly has been the underperformer with the possible exception of Darwin. But we need to take the Darwin data with a grain of salt because it is a smaller market and a very volatile market because it has some very significant seasonal patterns in terms of its buying and selling profile. But yes, Hobart is going the other way at the moment, and it'll be interesting to see how that pans out for the remainder of this year.
With affordability becoming an issue for many home buyers and investors, some have been turning to the apartment market, the unit market. How's that performed over the last little while, Andrew?
Well, we've seen the apartment market tracking the house market, Michael, disengaged itself to some degree over the August quarter compared to the July quarter, with prices flat following 6 consecutive quarters of growth. Of course, we've had 7 consecutive monthly quarters of growth since February in house prices, but the median unit price nationally was steady over that August quarter period, Michael. Sydney down a little bit, fell by 0.1% over the quarter. Melbourne down 0.5%. And they were the results that impacted, obviously, the national unit price. But Brisbane continues to keep on keeping on, up by 1.3% unit prices over the August quarter compared to the July quarter. Adelaide up 0.7% and Perth up 0.9%. They're smaller unit markets, of course, Michael. But when we look at the full year results this year so far, Adelaide up by 11%, Brisbane up by 7.4%. Sydney unit prices up 4.9% so far this year, which I think is quite an encouraging result for that portion of the market. And Sydney unit prices are actually 2% higher than where they were a year ago. But Brisbane and Adelaide have been the top performers, Michael, in terms of unit prices over the past year. Adelaide unit prices 15.2% higher over the year. And Brisbane unit prices, and that Brisbane unit market's been very strong for some time now, up by 10.9%. So some continuing positive results from Brisbane and Adelaide, and some settling there from Sydney and Melbourne over the August quarter.
Well, there's a number of factors behind this, of course. Consumer confidence, in particular buyer confidence, has become strong. People have got jobs, unemployment's low. I know some people are suffering because of rising mortgage costs, rising rents, rising cost of living. But in general, our economy is doing pretty well compared to what some people thought was going to happen. The mortgage cliff really hasn't created the amount of stressed mortgagee sales that some had predicted. So the housing markets have been surging. I guess migration in an undersupplied market's been a big factor as well, Andrew.
Yes, Michael. I think the key elements in the latest data, as I mentioned before, actually support a wait-and-see approach from the Reserve Bank. We saw the wage index, actual annual growth in wages fell over the June quarter compared to the March quarter. Annual wages up by 3.6% compared to 3.7%, which was a little bit of a surprise given just how strong our labour market has been, Michael, creating plenty of jobs, falling unemployed numbers, and still near record low unemployment rates. Now, the latest unemployment data over July, and of course, that lower wage growth was very important for the Reserve Bank in terms of its outlook for inflation, because higher wages is certainly a significant fuel for inflation. So that was one positive result for the Reserve Bank's decision to pause recently. And of course, we had an easing in the labour market. Unemployment rose to 3.7% from that record low 3.5%. We actually had falling of jobs created and an increase in the number of unemployed. But I do caution these numbers may reflect some adjustments that will be made going forward in the seasonal adjustment model, which I think is still being affected by the COVID lockdown period. But nonetheless, the data is what it is, and it is supporting steady rates going forward at this point of time. And the latest retail sales data, Michael, is also, even though we saw retail sales increase by 0.5% over July, the trend is certainly easing for retail sales. Still strong, up by 2.1% over the year, but the trend is certainly easing. So once again, it's sort of adding to the latest data, which is supporting a wait-and-see approach on interest rates. But we will get the latest inflation data out at the end of the month. When we get that inflation data, we will have a better picture of what's occurring. But certainly all the other data sets are supporting prospect of steady interest rates. Not so sure we're going to see a cut, Michael. I think a cut would only occur if we had a shakeout in our labour market, and I think we're still a long way from that occurring, fingers crossed. But of course, banks love to see interest rates moving because it gives them an opportunity to trim their margins. But nonetheless, lower interest rates, or certainly steady interest rates, are good news for mortgage holders, and certainly continue to offer stimulus for the housing market, with wages, although not rising as strong as they have been, still rising quite strongly regardless.
I just wanted to remind you that this is not specific investment advice, because we don't know your personal circumstances, but we're more than happy to have a chat to help you take advantage of this new property cycle. If you think about it, the opportunity like this to get set at the beginning of a new property cycle doesn't happen very often. So why not have an obligation-free chat with my team at Metropole to discuss your goals and to discuss your options. We're much more than just another buyer's agent. We help you safely create intergenerational wealth through property. We're big enough to tip the scales in your favour, but still small enough to care. And as we don't sell any properties, our advice is independent and unbiased. Now remember, property investment's a process. It's not an event. So you can't just go out and buy any property and hope to be successful. In fact, now more than ever, getting the right advice is critical. So if you're looking to invest in property or buy a new home, go to metropole.com.au and have a chat with our multi-award winning team. It's a great feeling having the team at Metropole on your side, levelling the playing field. Now, it wasn't that long ago, but boy, a lot's happened since then. The housing market peaked at the beginning of 2022. Yes. And then even before interest rates started to go up, remember that only started in May, the housing market started to move to the next phase of the cycle. House prices started to fall, but it looks like we've almost regained all the price losses.
Well, the national house price is just 0.9% below its previous peak, which was in April last year. Sydney and Melbourne are around about 2%, still lower than where they were at their previous peaks, which was in March last year at the peak of stuff. But of course, we know there was very strong growth through the post-lockdown period in Melbourne and Sydney. They're on track to reach their previous peak prices over the next few months, I think by the end of the year, if we do get what is looking likely a strong spring selling season. And it'll be interesting once we reach those peaks where the market goes from there, because prices growth has been, and it was something we've discussed, logically driven by that catch-up energy. Buyers have still got, with Melbourne and Sydney prices below their previous peaks, have still got that 2 or 3% up their sleeve in terms of a discount. So once we sort of get back to peak prices, we'll really only have growth in wages to fuel the capacity to push prices up. But certainly we've been in catch-up mode. It was always likely, Michael, given how strong our economy was, that we would rebound this year. And of course, that's what occurred. And we're just really catching up where we were at the beginning of last year.
Well, I've always suggested that until you've lived through a couple of property cycles, most people don't really understand how the markets work. Last boom, the 2021 boom, really was very unusual. It was a once in a generation boom because of a whole confluence of
Yes.
effects, but in particular, wartime interest rates, very low interest rates, to have double-digit price growth, or even the sort of price growth we're currently getting at the beginning of a cycle, is unusual and can't continue on. So I think we'd all be much happier with more moderate but general price growth and double-digit growth in 2024.
Well, look, once we've caught up, Michael, and as I said, that's what we're doing this year. Once we've caught up to where we've been, the only real capacity to push prices higher is higher wages. Now, we are getting that, but what it means going forward without significant interest rate cuts, and that would only occur with higher unemployment, I believe, it means that a prices growth, once we've caught up, will really move back, I believe, to that sort of 4, 5, 6% annual level, maybe more like 4 rather than 6. And the level of growth will depend on local factors in each capital city, such as the state of the local economy, migration, the level of building, and those types of factors. But we're now in an upward movement that's just really a rebound, given the discounts that we had last year due to higher interest rates, Michael.
It's great news that our markets have performed strongly. Look forward to catching up with you each week for our Property Insider Chat. Thank you, Andrew.
Yeah, thanks, Michael. And it's pretty exciting to think about the prospects of our spring selling season, and it'll be very interesting to see how that all pans out going forward.
Well, it sounds like it's going to be a very solid one.
Thank you, Michael.